first of all, give us your assessment of Chair Powell's performance today. I mean, he had a very challenging job, didn't he? Especially after the ECB surprised markets last week.
He had a challenging job. I think, as you said, he projected confidence. He has a plan. He presented the committee's collective wisdom through the dot plots, which show a mild increase, as you just heard, a steady increase through next year, topping off at 2.75 and then gently falling back to 2.4 in the long term. I think those of us who are looking at the news day to day, looking at the supply chain disruptions, would welcome an outcome like that. But it feels to me, at least, and to my colleagues who look at this stuff at the companies that they see day to day, that it's going to be a much bumpier ride than that. And in particular, the supply chain disruptions that will come out of the commodity shock from the Russia-Ukraine war are likely to keep prices higher for longer and make the needle that they're trying to thread that much harder to thread at the Fed.
Chair Powell actually did make reference to the Ukraine war, right? And tell us a little bit about how you're assessing the potential impact of the sanctions on Russia, not to mention, of course, a potential Russian default as well. We have that deadline this week. I know that you are an advisor to the Russian finance ministry, so you must know very well the inner workings of the country's economy.
Well, I'll just hasten to add, I was an advisor to the Russian finance ministry in the 1990s under President Yeltsin, so things have changed a little bit since then. I think what is dramatic is that these are sanctions that are going to be very painful for the Russian economy. They're going to be shut off from not just financial flows, but trade, very important imports of medicine, food, spare parts, airplane maintenance. A whole lot of things are going to be very difficult to replace. And the country is, in some sense, going to be sent back to close to what it looked like in the 1990s when the Soviet Union fell apart. I was surprised when Chair Powell mentioned the disruptions from Russia-Ukraine because he talked about it, but I'm not sure he really emphasized the disruptions to global supply chains. And I think that's what we're looking for, at least in the near term. The shocks that we have seen are likely to, spread to other markets, to other countries where there is not necessarily direct exposure to Russia, but for example, a spike in food prices has consequences in Egypt. A spike in nickel prices has consequences to the green transition. So all of these things, I think, have yet to play out, and that's what's going to make the Fed and the ECB face much greater challenges as they try to pace the level of policy normalization.
Christopher, we're seeing the view that it's going to be very hard, if not impossible, for Russia to come from this isolated financial and geopolitical wilderness that it's currently in at the moment. Will it take regime change for Russian assets to be investable again, for the economy to get back to some sort of level footing?
I think it's going to be a long time. And the talk today of a potential peace deal, I think we all hope for that. We hope for a ceasefire as soon as possible. But I think anything short of a Russian withdrawal, a Russian apology, a Russian reparations check is going to keep these sanctions from the U.S. and Europe on for a long, long time. And there might be some way to negotiate the flow of medicines, the flow of spare parts, that sort of thing. But I think it's going to be a long time before Russia becomes integrated again, investable again, short of, as I say, something much more dramatic than I think we can expect right now.
When you take a look at what we've seen, the resumption of the flattening of the Treasury curve, these concerns about longer-term rates going above the neutral rate, how large is the probability looming of pulling forward the next recession?
I think it's unlikely at this stage. I think, again, the companies that we look at have very strong balance sheets, continue to have fairly aggressive capital expenditure plans. I think if you look at the U.S. consumer, the savings rate is still high, the confidence is still high. We'll see if that wobbles with this news of the war coming through. So I think the U.S. economy is in pretty good shape. I'm a little more concerned about Europe, where the growth is not quite as strong and where the impact from Russia is much greater.